Okay, great! Now that we've learned about leasing, it would be great to exercise with an actual, real-life case study. The best way to learn is by applying new concepts in practice, isn't it? Okay, shall we do the exercise together? Let's go ahead. And once you've seen this video, you'll be able to download the files available with this lesson and solve the exercise on your own. Right, here's the exercise. A company called XYZ agrees to lease a fixed asset. The estimated useful life of the asset is 5 years. The agreed lease period is 5 years, and once the lease period ends, the asset will be returned to the lessor. The annual rent for the fixed asset is $14,000, and we assume a zero residual value for the asset. The asset's fair value is $50,000, and the lease involves an 8% annual interest rate. The question is, what is the right way to account for this lease? Is this an operating or a finance lease? And which are the exact mechanics to be applied when accounting for the lease at the end of year 1? Okay, first, it is easy to determine this is a finance lease, right? The company leases the asset for the rest of its expected useful life. So we can assume a finance lease, as this is one condition described in IAS 17, the lessee holding the asset for the most of its useful life. Okay, good. We'll have to capitalize the asset on the company's balance sheet and show a leasing liability on the opposite side. Therefore, in this case, we will have the following accounting entry. Debit fixed assets for $50,000 and credit leasing liabilities for the same amount. Right. Let's calculate how the asset will depreciate annually. We'll use the straight-line depreciation method. The asset has a 5-year useful life and a face value of $50,000. Therefore, we will have $50,000 divided by 5, resulting in an annual depreciation of $10,000. The accounting entries for depreciation would be debit D&A for $10,000, which is a P&L account, and credit accumulated depreciation, a balance sheet account, for the same amount. Okay, good. When we work with finance leasing, we must think of it as a loan we are amortizing. Therefore, we'll need to create the following table with 5 columns. The first column shows us the year we are in. The second column, the starting amount at that year. Then we have the interest rate applied in the financing, the overall rental expense paid for the lease, and the ending amount for the respective year. Please pay attention that we need the interest expense to be able to distinguish how much of the rental payment is paid for capital reimbursement and how much is paid for interest expenses. So, with an interest rate of 8% and $50,000 to sort of repay, we'll have an interest expense of $4,000. The overall rental we pay is $14,000, right? Therefore, the remaining $10,000 are used for capital repayment. Next year, we'll owe $40,000, and interest expenses will be accrued on these $40,000, not on $50,000. Okay, the exact accounting entries here are debit interest expenses for $4,000 and credit leasing liabilities for the same amount. And finally, we'll have the balance sheet entries at the end of the year. The carrying value of the asset will be $40,000, given we've accumulated depreciation of $10,000, and the liabilities for the finance lease are equal to $40,000, as we can see in the table. Okay, this is how we account for leasing. Please look at the exercise that comes with this lesson. It would allow you to practice these concepts on your own. We've also prepared a solutions file you can download and see if you've worked correctly once you are ready with the task. This will do for now. Thanks for watching.